Hello everyone, welcome to Tesla Daily News. Today is June 26th, Thursday, and the following is the latest Tesla news. We start with Tesla's stock action and some quick technical context for investors. Tesla shares opened at $375 and about 27 cents, traded as high as roughly $379.12, and as low as about $371.22, before closing near $375.12. Volume came in around 30 million shares, slightly active compared with typical recent sessions, and the close was marginally below the previous close of roughly $375.53. In short, the stock spent the day in a relatively tight range, with a small downward bias but no clear breakdown signal. For those who like a compact technical takeaway in just a few words, Tesla holds range, momentum slightly soft, trend still intact. Now let us move into the company-specific news that matters most for long-term shareholders and Tesla followers. According to several European outlets, including FNP in Germany and Index in Croatia, Tesla is launching a significant hiring and production expansion at its Gigafactory Berlin Brandenburg in Grünheide, just outside Berlin. This is arguably the most important operational story of the day for investors, because it speaks directly to demand, capacity utilization, and Tesla's competitive positioning in the European market. According to FNP, Tesla management told employees at a Works Council meeting that the company plans to raise output at the Grünheide plant by roughly a fifth later this year. Starting in October, the factory is scheduled to target about 7,500 vehicles per week. On an annualized basis, that translates to roughly 375,000 vehicles per year, or close to 390,000 using a full 52-week run rate, depending on how downtime and holidays are counted. FNP mentions that this step comes on top of a previously announced ramp. Back in April, Tesla had already said it would add around 1,000 employees to the German facility by the end of June and increase weekly output by roughly a fifth to about 6,200 vehicles starting in July. A Tesla spokesperson now explains that this first wave of hires is still in progress. Roughly 700 new workers have already joined, and recruiting the remaining positions should continue through July. From an investor's perspective, these details matter for two reasons. First, the hiring numbers give a tangible sense of Tesla's confidence in underlying demand. The company is not just optimizing existing shifts, it is scaling the workforce back toward, and slightly beyond, previous peak levels. FNP notes that a little more than 2 years ago, Grünheide employed around 12,400 people. That figure had since fallen by about 1,700 to roughly 10,700 earlier this year. With a new hiring plan in the vehicle factory alone, the headcount is expected to climb back to about 12,700 in auto production. Second, weekly output is an operational key performance indicator that investors can track against Tesla's long-term ambitions. When the Berlin Brandenburg Gigafactory opened in spring 2022, Tesla's initial target was 500,000 vehicles per year in the first phase, with potential expansion to about 1 million units annually in later stages. At 7,500 per week, Tesla will be running below that original 500,000 target, but the trajectory is clearly upward. For shareholders, the implication is that Grünheide is steadily maturing from an early-stage ramp into a more meaningful contribution to global volume, even if it has not yet reached its full design capacity. According to OP Online, which carries the same underlying DPA report, there is a jobs angle that is politically and sentimentally important. The outlet reports that, including the new vehicle production roles plus previously announced plans in battery cell manufacturing, Tesla expects to create about 3,500 additional jobs in the medium term at the Berlin Brandenburg site. The company also plans to convert roughly 500 temporary agency workers into permanent employees over the course of the year. For local economies and policymakers, this helps cement Tesla's position as a major industrial employer in eastern Germany. OP Online also quotes Brandenburg State Premier Dietmar Woig of the Social Democratic Party. He describes Tesla in Brandenburg as a continuing success story and a job engine for the region. For investors, this kind of political endorsement may not move the stock day to day, but it does lower perceived regulatory and permitting risk around future expansions. When state leadership publicly frames Tesla as a success guarantee for the region, it suggests a cooperative rather than adversarial stance as the company negotiates water usage, land use, and infrastructure issues that are common in large industrial projects. Another focal point of today's Grünheide coverage is the planned expansion of battery cell manufacturing at the site, which is particularly relevant for anyone modeling Tesla's margins and vertical integration strategy. According to FNP, Tesla intends to hire more than 1,500 additional employees for battery cell production in Grünheide, and the company is planning to invest close to €220 million, or roughly $250 million, to enable an annual production capacity of about 18 gigawatt-hours of battery cells at the site. Recruitment for these battery roles is described as being fully underway, although Tesla notes that hiring is somewhat more challenging because they need a large number of skilled specialists. Index, reporting for a Balkan audience but citing Tesla's own earlier statements, adds context to this battery plan. The outlet recalls Elon Musk's earlier vision that the Berlin Brandenburg complex should eventually become the world's largest battery factory. Tesla is targeting a jump in battery capacity from the current level around 8 gigawatt-hours to the projected 18 gigawatt-hours. According to that coverage, Tesla expects that by 2027, it will be producing both battery cells and electric vehicles at the same location end-to-end, which reinforces the company's strategy of tightening its supply chain and capturing more value in-house. For equity analysts, the trajectory of the battery program has several implications. Vertical integration into cell manufacturing can improve cost control and potentially support automotive gross margins, particularly if Tesla can optimize cell chemistry and pack integration for its vehicles in Europe. It may also give Tesla more flexibility in dealing with supply constraints or geopolitical concerns that could affect imported cells. On the other hand, the need for highly qualified workers and the capital spending outlays add near-term costs, so the timing and efficiency of this ramp will affect how quickly those investments translate into margin benefits. Turning to demand indicators, both F&P and OP Online highlight an important shift in Tesla's European sales performance that underpins this expansion. According to F&P, Tesla registrations in Germany reached about 5,111 units in May, representing an increase of over 320% compared with the same month a year earlier. That performance gave Tesla a market share of roughly 2.1% in the German market for that month. For a brand focused exclusively on battery electric vehicles, such growth in a key legacy auto stronghold is noteworthy. Meanwhile, Index, summarizing data from the European Automobile Manufacturers Association, notes that Tesla's sales across the European Union rose about 77% in the first 5 months of this year compared with the same period last year, reaching a bit more than 89,000 new vehicles registered. In May alone, nearly 22,000 new Teslas were registered in the EU, which is almost triple the number from the previous May. For long-term investors, this surge in European registrations helps counter the narrative of waning demand that weighed on Tesla sentiment in prior quarters. It suggests that pricing actions, product updates, and broader EV adoption trends are starting to translate into stronger unit volumes again, at least in Europe. Investors will still want to see how these volumes translate into revenue and margin in upcoming quarterly reports, but today's news flow supports the idea that Tesla is regaining momentum in an important region. One more macro piece that indirectly affects Tesla sentiment comes from broader coverage of Elon Musk's changing net worth, tied mainly to SpaceX and, to a lesser extent, Tesla. According to an English-language report based on Bloomberg and BBC figures, Elon Musk has recently lost his freshly acquired trillionaire status as technology stocks, including SpaceX and Tesla, have sold off sharply. Musk had briefly crossed the $1 trillion threshold in net worth after the much-anticipated SpaceX initial public offering. The stock surged to more than $225 per share, pushed SpaceX's valuation as high as roughly $1.7 trillion, and because Musk owns a large stake in that company, his paper fortune jumped accordingly. However, as markets reassessed high-growth tech valuations amid ongoing concerns about interest rates, capital spending, and the sustainability of AI-related enthusiasm, SpaceX shares retreated more than 30% from their peak to the mid-150s. Tesla shares also pulled back by nearly 6% on one of the rougher days. This combined move dragged Musk's estimated net worth back below the trillion mark, to roughly $957 billion, although he still remains the richest person globally. For Tesla shareholders, Musk's personal fortune is less critical than the operational developments discussed earlier. However, the story underscores how tightly Musk's wealth is tethered to equity in just a couple of companies. That concentration, and the volatility that comes with it, can amplify headlines and sometimes spill over into sentiment around Tesla's own stock. When markets are nervous about richly valued tech or space-related ventures, Tesla can get swept up in the same risk-off trade, regardless of its company-specific fundamentals. In that environment, concrete positive news from Grünheide about hiring, capacity expansion, and rising European demand may serve as a stabilizing counterweight. To wrap up, today's key Tesla themes for investors are clear. The Berlin Brandenburg Gigafactory is stepping up its vehicle output, hiring aggressively after a period of headcount reduction, and laying the groundwork for a much larger in-house battery cell operation. European demand trends appear to be improving substantially year over year, supporting the rationale for this capacity build-out. At the same time, the wider tech market remains volatile, and that volatility is visible in Elon Musk's headline wealth and in cross-currents affecting Tesla's share price. Thank you for listening to Tesla Daily News. If you found this update helpful, please subscribe, share the podcast with fellow Tesla followers and investors, and stay tuned for the next episode.